Okay, so now we're on to one of the parts I've been really looking forward to. We are going to talk about mutual funds, and these are dogs when it comes to investing. So active money management is expensive. Anytime you guys hear the words active management when it comes to money, I want you to think of expensive in your head. Most retail investors cannot afford professional management of their money, so for a while, this was kind of a problem. But then the mutual funds came around, and what this does is this allows small investors to collectively pool their money and have it managed on their behalf. So before the ETF, or the Exchange Traded Fund, was born in the 1990s, this was the only option aside from investing in individual stocks or paying for professional management. Now I'm guessing as somebody who was watching this course, you're somebody who is interested in managing your own money and possibly picking your own stocks for long-term investments or whatever strategy you do decide on. But for those of us who are not interested in an active investing approach and we want something more passive, for a while the only option you had was these actively managed mutual funds, but now the ETFs have really changed the whole investing scene. In a mutual fund, securities like stocks and bonds are constantly being bought and sold, resulting in a flurry of transaction costs and commission costs and a tax drag. So later on in this course, we're going to talk about investing taxes, and you have long-term capital gains tax and short-term capital gains tax. And oftentimes when these mutual funds are reallocating, a lot of those capital gains fall under the higher rate or that short-term capital gains tax. Another thing to realize about mutual funds is that a certain amount of the fund is always held in cash for redemptions, and this is known as the cash drag of a mutual fund. They always know that there's going to be a certain percentage of people that are going to redeem on any given day or any given period of time. So in order to have liquidity and the ability to pay those people off, they need to have a certain portion of the portfolio sitting there in cash, and sometimes they will leave some money in cash to wait for an investing opportunity. Now, as somebody who is investing, you may not be interested in that because that is known as a cash drag, and that is money that could be working for you, but it's not because they are leaving it there in cash. So the expenses for managing the fund as well as researching and analyzing stocks are passed along through the expense ratio. And most people should hold exchange-traded funds instead of mutual funds. Now, I was going to go into a whole section on this and talk all about this, but I really didn't feel I could do this justice just because so many people before me have addressed this topic. If you guys really want to learn about the true cost of active money management, I want to point you in the direction of Money Master the Game by Tony Robbins, or if you want a more condensed version of that book, he recently released the book called Unshakable, and those really pointed out to you what the true cost of active money management is. But I am going to go over a few statistics for you, but just understand that the mutual funds came around as a solution to the fact that most small investors could not afford active money management. They can't pay a financial advisor to invest on their behalf. But when they collectively pooled their money, they could afford to have professional money management. However, now that the ETFs have hit the scene and people can have broad market exposure at a very low expense ratio, most mutual funds are not beating what these markets are paying. And this is why most investors, if not all investors, should be holding exchange-traded funds. I want to throw this statistic at you guys. So in a 10-year period ending in 2015, 82% of actively managed large-cap mutual funds failed to beat the return of the S&P 500. So mutual fund investors pay a premium for the active management of the fund. However, if 82% are not beating the market, what exactly are you paying for? What value are they adding by actively managing that fund? If you have a mutual fund, make sure the fund is consistently beating the return of the market. I want you guys to realize that in that 10-year period, you could have invested in a Vanguard 500 fund that tracked the S&P 500 for a very low expense ratio. I'm talking a fraction of what these mutual funds are charging you through an expense ratio, and you would be paying less in expenses, also beating the return of that mutual fund. So if you guys currently have a mutual fund, what I want you to do is I want you to benchmark it to the S&P 500. I want you to take the performance of that fund, compare it to the S&P 500, and remember to subtract the expense ratio from that return. So if you saw a 9% return from your mutual fund, but they're charging a 2% expense ratio, understand that's really a 7% return. So if after expenses your mutual fund is consistently beating the market return, then you have a good mutual fund. But most of them are not. In fact, 82% are not beating the market before you even factor in the fact that their expense ratio comes off of the return. The number is very low, guys. Very few mutual funds are beating the market return, and that is why most passive investors should hold index funds or exchange traded funds. You should not be investing in mutual funds unless your mutual fund is consistently beating the S&P 500 and the overall return of the market. Other than that, you should just hold the broad market through an ETF. Okay, so now we're going to talk about my favorite investment vehicle, the exchange traded fund. So mutual funds and ETFs are very similar, so we're kind of going to be going back and forth in this section here. Now, an ETF or an index fund is a fund that tracks a specific underlying market. So later on, we're going to talk about stock market indexes. I'm sure you're already familiar with the S&P 500, the Dow Jones Industrial Average, and you could find an ETF that tracks both of those. So the truth is, most investors are not able to consistently beat the market. And if we use the statistic from the last slide, we saw that 82% of professional money managers are not able to do this. So the big question people ask is this: if these professionals are not able to beat the market, how would you be able to beat the market? But you do have to understand that when you're managing a larger amount of money, you can't necessarily change things around as easily, and you do have things like cash drag that are going to slow down the fund as a whole. So I think if you are an active manager of your own money and you really do know what you're doing, and you really do study and focus on long-term investing and really understanding the value of what you're investing in, you could be somebody who beats the market. I mean, I've been able to beat the market on a pretty consistent basis here, so it's not impossible. But many people are not even interested in trying that, but they still want to invest, and that is when you should be investing in these exchange-traded funds. Rather than picking stocks and trying to beat the market, many decide to own a piece of the broad market, which is a great strategy. And rather than paying for active management with lackluster performance, and by lackluster, I mean, as you can see, 82% failed to do their job, most should hold index funds over mutual funds. In fact, I believe everyone, unless you're in a mutual fund that consistently beats the S&P 500 at a rate that exceeds the expense ratio. So even if they're getting a 9% return, if they have a 3% expense ratio, they're probably not beating the average return or the annualized return of the S&P 500. So rather than paying for active money management when these active money managers are not able to provide the results you are expecting, just own the whole market. Rather than trying to beat the market yourself, many people want to just hold a broad market index. So an index is a tool used to measure the value of a portion of the total market, and we're going to talk about indexes later on. Index funds are designed to replicate the performance of the underlying index. So if there was an index fund tracking the S&P 500, the index fund would be allocated such that it replicated the performance of the S&P 500. Now, index funds give you broad market exposure with a lower expense ratio due to the passive management. So there's no active analysis, there's no active research that goes into an index fund because they're just replicating the performance of an underlying index. And as a result, the expense ratio is significantly cheaper. And even better, I recommend Vanguard index funds because they are some of the lowest fee index funds on the market. So if you're going to go with index funds, which I recommend you do, or these exchange traded funds, your best bet is to go through Vanguard, and they offer index funds you can invest in like a mutual fund through the Vanguard account, or exchange traded funds that trade on the secondary market like a stock. So the other benefit to exchange traded funds is that the only time the investments change is when the underlying index changes. So as a result, index funds have a lower turnover, resulting in less commission costs and tax drag, because most of this is going to fall under the long-term capital gains tax. So all of these things combined make index funds a great passive income strategy. And they're very simple. There's not a lot to them. It's very passive. You go ahead and buy index funds, and maybe you're going to follow the strategy of dollar cost averaging, which we're going to talk about later, where you're slowly adding to this over time, and maybe you have an ETF fund tracking the S&P 500 and an ETF fund of high-quality long-term government bonds, or whatever your bond allocation is. And over time, you're just going to continue to add to these things. The biggest difference between a mutual fund and an exchange-traded fund is how they are purchased. So mutual funds are purchased through the issuing investment company. So maybe it's Franklin Templeton, maybe it is Fidelity, but you're going to go through that website and you're going to open an account with them. And oftentimes they have a minimum balance to actually open an investing account. So ETFs are traded on the secondary market like a stock, which is beneficial to investors because if you already have a trading account, you don't have to set up a separate account in order to invest in an index fund. You can do it through exchange-traded funds. This is index funds traded like a stock. So most mutual funds, like we said, have a minimum balance to open an account, while an ETF can be purchased as individual shares. So you can get involved with an ETF for the price of a single share, whereas with a mutual fund or an index fund, you would have to pay the minimum balance. And I do know if you go on the Vanguard website, they call these a mutual index fund. So they do call them a mutual fund, but it's a very low expense mutual fund. Now, ETFs are significantly cheaper in terms of management fees and expenses. You guys can look at the average expense ratio of this or compare some of the Vanguard funds to the other funds out there. And this is represented in the expense ratio of the fund. Okay, so now we're going to have a little bit of fun here. I'm going to compare the performance as well as the expense ratio of one of the most expensive mutual funds I have ever found compared to a Vanguard index fund. So here we have the Oppenheimer Steel Path MLP, which is a Master Limited Partnership, Select 40. So this is basically a fund that invests in oil and gas limited partnerships. And as we can see, this mutual fund has an astronomical expense ratio of 5.66%. This is one of the highest expense ratios I have ever come across. So I want you guys to pay attention to this chart, okay? And tell me if you see any similarities when we look at the next chart. Because I'm guessing, as you can tell, they look very similar. Very similar performance from these two funds here. So here we have the Vanguard Energy Index Fund Admiral shares. So this is a pool of stocks of companies involved in energy products such as oil and gas. And look at that expense ratio, guys. The expense ratio for this Vanguard Index Fund is 0.1% compared to an expense ratio of 5.66% from the actively managed mutual fund. And as you can see, the performance over the last 5 years has been very, very similar. So this is just an example of how expensive mutual funds can really be. And this is why you can usually find an index fund that's going to give you the exposure that you're looking for. Both ETFs and mutual funds are pools of money allocated into a portfolio of investments. Both ETFs and mutual funds offer diversification through broad market exposure. The investor who buys either a mutual fund or an ETF has no input on what investments are included within the fund. So this again comes down to whether you're looking for a passive investing approach or an active investing approach. If you're looking for a passive approach, you would be somebody who invests in funds because you do not want to be worrying about asset allocation yourself. But if you want a more active approach, you might be somebody who invests in individual stocks themselves because you want to have a say in what you're investing in. Now, both ETFs and mutual funds are passive investing approaches, and there's no reason to say you couldn't have a mix of a passive and active investing approach where maybe you have half of your money in ETFs and you have half of your money in individual stocks. This might not be a bad strategy either if you want to have a mix of both worlds there.